Did you know that 82% of businesses in the US fail because of cash flow problems? You'll also be surprised to know that the cash flow issues are a telltale sign of flawed bookkeeping. To run a successful business, you need to understand its financial health at all times. This way you can be informed on financial decisions about budgeting, tax planning, funding, borrowing, and so on and so on. This is where bookkeeping comes in. By definition, bookkeeping is the practice of recording and organizing all financial transactions your business does. Basically, you're keeping track of all that the money comes in and goes out of your business. Among other things, bookkeeping helps you monitor your cash flow, budget and allocate resources, comply with tax regulations, demonstrate financial credibility to investors and lenders, identify areas of weakness, and even plan for growth or expansion. As you can already tell, bookkeeping can make or break your business. That is why if you want your business to survive and thrive, you must avoid these 3 common bookkeeping mistakes. But before that, have you liked and subscribed to the video? Let's get started. Mistake number 1 is mixing your personal and business finances, aka commingling. This is hands down the biggest bookkeeping and accounting mistake you can make, as it can potentially cost you both financially and legally. But unfortunately, it happens more often than not, especially with entrepreneurs who own and run sole proprietorships. That's because unlike LLCs and corporations, you're not required by the IRS to keep accounts separate. And so being a sole proprietor who not only acts as the CEO, but also is the procurement manager, the sales manager, and the marketer, it may make more sense to you to keep things in one place from a management standpoint, but that should not be the case. So you'll think, since I've already have my own checking account, why don't I receive customer payments with it instead of having 2 separate accounts? And because this is a payments, because this is payments are business income that should pay business expenses, you then use the same account to pay your suppliers, business premises, utilities, and even employees or contractors if you have any. Remember, you also using the same account to receive your pay slip, assuming you have a day job, as well as to pay for your groceries, household bills, and any other personal expenses. But this is where the problem lies. When you have just one set of accounts, you put yourself and your business at risk, because what may have started as simple, practical approach will become a major headache later on. Now you'll be forced to categorize every income and expense as either personal or business, or else you won't be able to tell if your business is actually making money. And with transactions so much harder to separate, your taxes also become much more difficult to manage, which could not only see you missing out on substantial tax savings, but also get the attention of the IRS. The last thing you want is to have your business audited when your records are a complete mess. Not forgetting having clients and investors write checks or make transfers to your name instead of your business name brings up a lot of credibility issues and may illegitimize your business. Mistake number 2 is failing to reconcile your accounts. Can't figure out why your bank balance isn't matching what you have in your books? That's probably because you don't reconcile your accounts. And if you do, it's often not enough. Account reconciliation is one of the most crucial bookkeeping tasks and a top priority if you handle your own books. By definition, accounts reconciliation is comparing 2 sets of financial data to ensure their accuracy. Simply put, you compare your business bank statements against your ledgers to make sure everything in the statements checks out with what you have in your books. It is here that you can spot errors and possibility fraud and make a follow-up of this. But unfortunately, many small business owners think bookkeeping is just recording transactions that the business makes, or they are just overstretched from wearing the many management hats that they really don't see the value of, such as a tiresome process of bookkeeping. But failing to reconcile your accounts could have disastrous consequences for you and your business. Basically, you risk undetected financial fraud, financial reporting errors, and regulatory issues. This can eventually lead to significant losses, credit control issues, and damage your business reputation and standing. Mistake number 3 is ignoring small expenses. Running a business means that you'll be incurring all kinds of expenses. For the most part, business owners record these expenses as they help calculate income and consequently profits. More importantly, they come in handy when it's time to claim those deductions on your tax return. That said, like most business owners, you probably ignore the small expenses, like the couple of dollars you spent on stationery or minor repairs on your business premises. Usually these don't seem like much, which is why most entrepreneurs either dismiss or classify them as personal expenses. But the truth is, they do add up over time, and if you don't track them and record them in your books, they can give you a lot of headaches later when you actually want to claim these deductions. Now, the good news is that these 3 mistakes we talked about and other smaller ones you might be making can be avoided, and you don't need to be a professional accountant to do it, although it might be helpful to hire one, especially if you're overwhelmed with other responsibilities in your business. Let's talk about some tips and strategies to avoid these grave bookkeeping mistakes. Number 1 is separate your personal and business finances. There are a couple of things you can do to effectively separate yourself from your business. The first is to change the structure of your business from a sole proprietorship to an LLC or an S Corp. This way your business is legally recognized as a separate entity. Once that's out of the way, you want to open a checking account under your business name. This is the account you will use to order and receive payments. And since this is your business and now a separate entity, it doesn't depend on your credit score anymore. So you also want to get a credit card for your business for business related expenses. I want to make sure I say that crystal clear. You can't pay cash with, and helps you to grow your business credit if you have a business credit card. Now the question is, since this money is not coming into your personal account, how do you pay yourself then? The best strategy is to view yourself as an employee of your business. That means payments for the business have to go through your business account first. From there, you can also draw some of that money to your personal account as a salary for your role into the business. Remember to also keep your business receipts at work and your personal receipts at home so there isn't any confusion come tax time. Number 2 is reconcile your accounts at least once a month. Maintaining accurate financial records is the best way to avoid losing money unnecessarily, whether that's through mismanagement or even fraud. So don't wait too long to reconcile your books so there won't be any drop off in the coming months. The rule of thumb is to reconcile your accounts every month. This way you're able to catch mistakes early before they balloon to major cash leaks. Number 3 is record and organize all your business expenses. All business expenses matter, especially in the beginning when the business is not making much money just in terms of profit. That's because you can use them to reduce your taxable income, which is very key in the beginning. So make it a habit to track all your expenses and record them in your books. You just need to categorize them. In this case, use standard bookkeeping practices to do so, but try to keep things simple. Now, something important here, you want to keep receipts. We're not just talking about digital records. Make sure you also have a reliable backup system. Remember, data can be lost. In this case, you can fall back to your paper documentation just in case. As for small business expenses, you want to have a custodian for your business petty cash. This ensures accountability and makes things a lot easier for your accountant when it's time to file your taxes. Number 4 is get a professional bookkeeper. Most business owners hate having to deal with their books. However, many would rather do it than spend money on a professional, which is how some of these mistakes happen, honestly. The truth is, if your business is making numerous transactions daily or weekly, getting a qualified accountant or bookkeeper might just save you money and ensure your business survival. Now listen, they don't have to be there full time. You can't always come up with a plan that works best for your business. Proper bookkeeping, while tedious, is integral for your business. It helps you understand how your business is doing financially, including how much your income and expenses are, so that you can budget appropriately and fulfill your tax obligation. More importantly, good bookkeeping practices ensure that you can be spot on financially and spot a financial problem a mile away. Not having a proper bookkeeping system is a recipe for business failure. What is your experience with bookkeeping for your business? Have you had to learn it the hard way? Share your experiences with us in the comment section below. We have more financial management videos for individuals, entrepreneurs, and small business owners that you should definitely check out. And we upload regularly too, so subscribe and turn on your notifications so you don't miss out. Thanks for watching. Tune in next time.